Time now for our Options Corner. Joining us to take a deeper look at this chart is Rick Ducat, Duke of Data himself. All right, Rick, what do you notice about the trends in this one?
Well, I mean, Texas Instruments doesn't seem to have been invited to the semiconductor party this year here, because SMH is up like 37%, the semiconductor ETF. TXN down about 8.2%. So, kind of what's different about them is that they're not really the high-end computer chip type stock here. They're more for larger, older models that are more stable, more reliable for industrial and automotive markets here. So even against companies that are maybe a little bit more similar, like NVIDIA, Intel, those are like the computer chip companies, but more specifically, Qualcomm, Analog Devices, faring similarly here. So, the semiconductor sector is not all are created equal in this space here. So if we were to look at our candle chart here, falling wedge type pattern is what we've seen since we hit these highs near 221. So if we were to look a little bit toward the downside here, we can see this supportive zone, 172 to 175, our dark green and light green line, represents some high points and gaps in supportive areas here. So this was a key point for the bulls to hold on to. It did seem like we got a nice bounce yesterday, but it kind of took us back just to the middle of this range that we've been trading in. 175, 172 to the downside here, 187 more to the upside is where price has topped out a couple times. So look for the bulls to reclaim that level if we want to break into a new uptrend here. Our moving averages come together right around here near 185. We have our orange 63-day and purple 252-day, so that's right at the beginning of that resistance zone. Notice as well that the RSI is on the verge of crossing above its trend line and above the 50 midline. That would be more of a bullish shift for momentum. Finally, if we were to look at our volume profile and standard deviation channel studies, we can see that our volume profile point of control and our linear regression line, our fair value line, our line of best fit, those also align near 185. This is the big trading area here, kind of that same range we've just been discussing. So this is a key point to break out of. We are entering into this congestion area, so to speak, now. If we do start to break above 191 and fill this gap, perhaps the next stop might be here near the 200 level.
All right. Thank you, Rick. That is Rick Ducat, lead market technician here on Schwab Network. Now take us through an example trade. We've got Tom White, senior options contributor and co-host of Fast Market. So, Tom, given the weakness that we've seen in Texas Instruments so far this year, what's your approach for an example trade?
Yeah, you got to remember the stock hit all-time highs a couple months ago, but has fallen about 19% from those levels. So underperforming, down about 4% this year. So I looked at a strategy that takes advantage of some vol dispersion if you think it's going to maybe rebound. Remember, 70% of their revenue is based on automotive, and we've seen some pretty good earnings reports from Tesla, from GM recently, so maybe that'll give it a leg up. But if you think it's going to rebound, this strategy takes advantage of it and takes advantage of some of the vol levels that we're seeing in the stock. So going on to the October 31st weekly cycle, so 10 days to expiration, we're going to buy the at-the-money 180 strike call. That's where the stock's going to open up. And then against it in the near-term October 24th weekly options that expire in 3 days, we're going to sell the 190 strike call, so a bullish $10 wide call diagonal. You're going to pay roughly about a 470 debit if the stock opens up here around 180, so less than half the width of this bullish call diagonal. Now, implied volatility levels in the option market are pricing in about a plus or minus 5.5% move, about $10 either way. So this aligns with that $10 expected move to the upside. Remember, it's bullish. You've got to take that into consideration. Now, why are you paying less than half the width of this call diagonal? Well, you're buying about a 59% implied volatility on aggregate in that October 31st weekly 180 call, selling about an 82% implied volatility on aggregate in that 190 call in the near-term October 24th weekly option. So that vol dispersion lowers the entry point. Now, where is your break even? Anything above about 182 is going to be profitability on this trade. So you do need that move to the upside, but that break even's only just over 1% above the current share price in Texas Instruments going in. So low bar going into this. If you think it's going to rally post earnings, this type of strategy takes advantage of that.
All right. Thank you for that example trade there on Texas Instruments. That's a call diagonal is the approach there. Thank you, Tom.